Welcome to the Motley Fool's Crunchtime series, where we scout out a single company from the story to the opportunities and risks. Time to take a closer look at one of the biggest global automakers. It's Ford. But first, my prediction. I don't think Ford has what it takes to be a market-beating investment over the next 5 years, and that's coming from a happy Ford pickup owner. Let's dig in. Ford is one of the largest automakers in the world and has a significant share in North America. Now, it's struggled to maintain and grow its share against increasing global competition in recent years. Its core strategy is to design vehicle platforms that it can leverage in multiple markets, putting its global manufacturing footprint to the best use to build vehicles in or close to the markets where demand is strongest and there's the most profit opportunity. In North America, that's pickup trucks and SUVs, which make up the bulk of its profits and cash flows. Ford also has a large finance business where it makes money originating and holding auto loans. The business comes with the risk of customers defaulting, but it helps smooth out what can be a lumpy cyclical business of making and selling new cars. Its core markets are very mature, so the growth opportunity is minimal. It's more about building brand loyalty and keeping customers when they buy a new vehicle. There is some opportunity as we transition to electric vehicles, but Ford, along with most of its legacy auto giant peers, have pushed much of their EV plans back due to softer than expected demand due to concerns over charging infrastructure, vehicle range, not to mention the skyrocketing electric vehicle prices that we've seen. Even much of Ford's international growth opportunities are challenged. This is especially true in Asia, with the rise of several popular Chinese car brands that are taking share in that country and others too. Automaking is an incredibly cyclical industry, and its manufacturing facilities have high fixed costs. That can cause it to move from very profitable to losing money quickly when the cycle for demand turns. Combined with it being a very mature industry, valuation is really important, along with understanding where things are in the ups and downs of the economic and the demand cycle for automobiles. Paying too high a price or buying it near the peak of the demand cycle can result in poor returns at best and massive losses at worst. Just ask anyone who bought Ford in 2021, counting on the EV transformation revolutionizing the auto industry. Additionally, execution risk is a big factor. Ford's multi-billion-dollar commitments to EVs has not been profitable so far. The F-150 Lightning is reporting weak and shrinking sales numbers. Ford, as a result, has pushed most of its next-generation EV investments down the road. Ford also has the additional risk as a lender. Historically, Ford Finance has managed risk very well, but we're going to face a recession at some point. When that happens, loan losses are going to be a reality, and that will take resources away from Ford's ability to innovate and compete as an automaker. My prediction, Ford's shares look reasonable at around 11 times earnings. Its dividend yield is around 6%. Might look attractive to a lot of investors, but it's worth noting that Ford stock traded for an average PE ratio around 12 times between 2012 and 2020. Investors earned a whopping 25% in total returns. It's about 2.9% a year on average. Over the same period, the S&P 500 tripled in value. That's closer to 15% a year over that same period. Ford may be a great company, which I believe, but I think investors can do better investing outside the auto industry. All right, let's wrap this up. At The Motley Fool, your comments make us all smarter. Please comment with your own research and insights about Ford. Plus, tell us what stock you want to see us tackle next. Go to fool.com/invest to receive the top 10 best stocks to buy right now.